Okay, for our final exercise in chapter 24, we're going to take a look at a decision businesses face from time to time, whether or not to accept additional business at a price that's lower than the normal price that they charge. Now, we're going to look at the numbers part of this, of course, but there are also some other considerations. We'd call those, rather than quantitative considerations, we'd call those qualitative considerations that should be taken into account in this situation. We'll talk about those a little a little bit more as we go along. But here, let's read through it. Portable Power Company expects to operate at 80% of productive capacity during July. That's important because they would be able to accept this special offer without having to rent or purchase a new manufacturing facility. They have room to complete this order in the facility they're currently using. In other words, the total manufacturing cost for July and the production of 25,000 batteries are budgeted as follows. And they go through all the variable costs: direct materials, direct labor, and variable factory overhead. Then they also list fixed factory overhead, and they give us total manufacturing costs for total budgeted manufacturing costs for the 25,000 batteries. Okay, here's the situation though. The company has an opportunity to submit a bid for 2,500 batteries, and if 25,000 is 80% of capacity, of course they'd still be under 100%, adding 10% to that. They'd put them at 90, I believe. Anyway, they have an opportunity to submit a bid for 2,500 batteries to be delivered by July 31st to a government agency. If the contract is obtained, it is anticipated that additional activity, the producing of the special order, will not interfere with normal production during July, and it will not increase the selling and administrative expenses. What is the unit cost below which Portable Power Company should not go in bidding on the government contract? What they're asking is, what's the lowest possible bid they could submit and be okay? Okay, in this case, you guys, if they take the bid, or if they get accepted, if their bid gets accepted, or if it doesn't, their fixed costs are going to be there either way. So the only relevant costs to this decision are the variable costs. So let's list those out. First, let's do the company name. It was Portable Power Company. We'll say we're preparing this as of July 1. We'll say last year, 2015. Or it hasn't happened yet, so let's go 2016. Okay, now let's list out. We have direct materials. We want to list all of our variable costs, because they're the only ones that will change if we accept this special order. They're our differential cost, if you will, of accepting this special order, or even if you won't, for that matter. They are our extra cost or differential cost of accepting this special order. Okay, direct materials would be $162,500. That's the budgeted amount. Okay, then we also have direct labor, which is in total $70,000. This is for the production of those 25,000 batteries. We have variable factory overhead. We only want to consider it. We do not want to consider the fixed factory overhead, because whether we accept this special order or decline this special order, that fixed factory overhead is still going to be present. So our variable factory overhead, $30,000. So let's get a total here. total variable cost of producing 25,000 batteries. Clean this up a little bit. There we go. Okay, now we want per unit variable cost so that's going to be our total variable cost divided by the 25,000 batteries. Now that says 11. I think we wanted a little more exact. Let me change the formatting there. So our per unit variable cost is $10.50. That would be as low as we would possibly want to go. Now if we get the order for $10.50, we're actually not making any profit, but we would be breaking even. We might still want to do that because it could help us get more government contracts in the future that we could make a profit on if we get this bid. I would want to bid something above $10.50 so you're making something on the order. Now the problem here, the qualitative consideration that I alluded to earlier, is if we're normally charging, say, $20.50 per battery, then we don't want our normal customers to find out we're doing this special order for the government at $10.50 when they're the ones buying our 25,000 batteries that we produce. It could contaminate the market if they find out we're selling this special order to the government at $10.50 each or $12.50 each, you could say. The bare minimum you'd want to go though is $10.50. If you go down to $10, then for every battery you're losing 50 cents. So we could say the lowest acceptable bid should cover the company's variable cost per unit of $10.50. Should actually probably be above that to get into profit, but definitely it should not be below that amount. Okay, I hope that one makes sense as well, you guys. Your fixed costs are not relevant there because we're below maximum capacity, and we could produce this special order for the government at $10.50 a unit. I don't know, it depends on what our most important consideration is. Do we really want to get this order? If so, we might bid $10.50 per battery, hoping that we get bigger orders in the future. Maybe we can charge a little more. I would say, though, you'd want to bid something above $10.50 per unit so that it's beneficial. The point is, if the bid is below $10.50 per unit, you're losing money on each battery. Okay, thanks a lot. Practice those on paper, and I'll be in touch if you have any questions. Thanks.